There's a well-known saying, "Those who do not learn from history are doomed to repeat it." This phrase is often invoked as a guiding principle, urging us to study the past in order to avoid its mistakes. But when it comes to investing, does this wisdom truly hold up? Could relying too heavily on historical patterns actually lead us astray? In this section, we'll explore whether learning from history is a reliable strategy for investors, or if it might be a subtle trap that clouds judgment and decision-making. The answer is more complex than it first appears. When we encounter a compelling quote, it often leaves us feeling enlightened and perhaps even a bit superior, as if we possess a deeper understanding than others. This sense of confidence can be reassuring, especially when making investment decisions. However, it's important to consider whether this mindset truly benefits us. Feeling informed may lead to overconfidence, causing us to overlook risks or ignore alternative perspectives. By questioning the impact of this attitude, we can better assess whether it guides us towards sound choices or inadvertently introduces bias into our decision-making process. Ultimately, true wisdom in investing comes from humility and continuous learning, rather than relying solely on the comfort of familiar insights. Consider the possibility that accepting this quote at face value could be one of the costliest mistakes an investor might make. While its message may seem reassuring or even wise, it can subtly encourage complacency and discourage critical thinking. Investors who embrace such ideas without scrutiny risk overlooking important market signals and failing to adapt to changing conditions. This intellectual trap can lead to missed opportunities, unnecessary losses, and a false sense of security. In the world of investing, unquestioned beliefs can be far more expensive than any single bad trade. Recognizing and challenging these seductive notions is essential for long-term success. This section explores 3 interconnected investigative loops. First is the enigma of the quote, where we examine a famous saying that often circulates in financial circles, questioning its true origin and meaning. Next, we delve into the true lesson of history, uncovering what past events genuinely reveal about market behavior and investor psychology. Finally, we address the popular myth that misleads investors, identifying widespread misconceptions that can lead to poor decision-making. Together, these loops provide a framework for understanding how narratives shape investment strategies and perceptions. Take a moment to consider your own experiences with market bubbles and the feeling of FOMO, or fear of missing out. Have you ever found yourself swept up in excitement, making decisions based on what others were doing, rather than your own analysis? Reflecting honestly on these moments can reveal valuable insights about how emotions and crowd behavior influence financial choices. By acknowledging these experiences, we lay the groundwork for a more open and meaningful discussion. Your personal reflections are an important part of understanding the broader dynamics at play in markets. As we approach the conclusions of Loop 3, it's important to consider how the quote has often been adopted as a cynic's crutch. In this interpretation, the phrase becomes a tool for passive observation, allowing individuals to distance themselves from events without engaging or intervening. Rather than inspiring reflection or action, it can serve as justification for inaction, reinforcing a sense of detachment from the world. This perspective suggests that the quote enables people to watch events unfold with a sense of resignation, rather than responsibility. By examining this cynical usage, we gain insight into how powerful ideas can be repurposed to support very different attitudes and behaviors. Failure Mode 1 centers on the perma-bear, an investor who consistently avoids participating in the markets due to a deep-seated cynicism. This individual is perpetually skeptical, anticipating downturns and crises rather than opportunities. As a result, they remain on the sidelines, missing out on the compounding growth that markets can offer over the long term. While their caution may shield them from short-term volatility, it also prevents them from benefiting from periods of recovery and expansion. Over time, this approach can lead to significant underperformance compared to those who remain invested. The perma-bear's mindset illustrates how excessive pessimism can be just as detrimental as reckless optimism when it comes to building wealth. Failure Mode 2 centers on the arrogant timer, an investor who is convinced they possess the unique ability to predict market movements and outmaneuver the crowd. Driven by confidence, they attempt to buy low and sell high, believing their timing will yield superior returns. However, this approach often leads to costly mistakes, as market timing is notoriously difficult and unpredictable. The arrogant timer may ignore warning signs and dismiss the wisdom of diversification, relying solely on their own judgment. Over time, hubris can result in missed opportunities, emotional decision-making, and significant financial losses. Ultimately, the belief that one can consistently outsmart the market proves to be a dangerous illusion. Both failure modes originate from a fundamental misuse of the quote. When taken to an extreme, one interpretation can foster paralyzing cynicism, causing individuals to doubt the possibility of genuine action or progress. This skepticism may lead to inaction and a sense of helplessness. On the other hand, misapplying the quote in the opposite direction can breed dangerous overconfidence. People may ignore legitimate concerns or complexities, believing their actions are unquestionably justified. In both cases, the original intent of the quote is lost, resulting in either stagnation or reckless behavior. While many believe that timing the market is the key to investment success, history tells a different story. Instead of relying on popular myths, it's important to examine what the past reveals about effective investing strategies. What lessons can prudent long-term investors draw from decades of market data and experience? By challenging conventional wisdom, we can uncover insights that guide smarter decisions and foster lasting financial growth. Let's explore what history truly teaches those who invest with patience and discipline. Throughout history, one lesson stands out above all others. Human nature remains unchanged. This enduring constancy shapes the way people respond to economic events, market swings, and financial opportunities. By recognizing patterns in behavior, such as fear, greed, and optimism, investors can anticipate how markets are likely to react during different cycles. Understanding these psychological drivers provides a valuable advantage, allowing for better preparation and decision-making. Ultimately, while technology and circumstances may evolve, the core instincts guiding investor actions persist, making historical insight a powerful tool for navigating the future. Legendary investors like Benjamin Graham understood that financial markets are shaped by cycles of optimism and fear. By studying past crises and investor behavior, Graham recognized the importance of preparing for uncertainty. He developed principles such as the margin of safety, which involves purchasing assets at prices significantly below their intrinsic value. This approach acts as a buffer against mistakes in judgment and unexpected market downturns. Graham's system was designed to minimize the impact of human error and emotional decision-making, helping investors remain disciplined even when markets become volatile. Through these safeguards, he demonstrated how learning from history can lead to more resilient investment strategies. At the heart of this experience lies a crucial lesson: humility. Recognizing our own limitations is essential when navigating complex decisions. By adopting a disciplined, rules-based process, we create safeguards that help prevent impulsive choices driven by emotion. This approach encourages consistency and objectivity, reducing the risk of costly mistakes. Ultimately, true wisdom comes from acknowledging that no one is immune to bias, and that structure is key to making sound decisions. Returning to the central enigma, we now uncover the true nature of the quote. What initially seemed like sage advice is, in fact, a subtle trap. By relying on this phrase, investors may feel justified in skipping the rigorous work of research and preparation. The aha moment arrives when we realize that the quote offers comfort, but not substance. It excuses us from the diligence required to make informed decisions. In essence, it provides a shortcut that undermines genuine understanding, leaving investors vulnerable to unforeseen risks. In the world of investing, it can be tempting to rely on clever observations or witty remarks as a substitute for true self-examination and the disciplined construction of a sound investment system. While sharp insights may feel rewarding in the moment, they rarely provide the foundation needed for long-term success. Genuine self-reflection helps investors recognize their own biases, limitations, and emotional triggers, which are crucial for making rational decisions. Building a robust investment system requires consistent effort, clear principles, and a willingness to learn from mistakes. Without these elements, investors risk making decisions based on fleeting impressions rather than solid analysis. Ultimately, the danger lies in mistaking cleverness for wisdom, and in doing so, undermining the stability and reliability of one's investment approach. The quote, "Those who do not learn from history are doomed to repeat it," often serves as a warning to others. Yet, when we examine its use more closely, it can act as a mirror, reflecting back on those who invoke it. Frequently, the very people who repeat this phrase may overlook their own patterns and mistakes, failing to recognize how history applies to them. By using the quote to judge others, they may inadvertently reveal their own blind spots. In this way, the quote challenges us to look inward and consider whether we are truly learning from the past, rather than simply admonishing others. At the heart of successful investing lies a simple yet powerful philosophy. Lasting safety and peace of mind are achieved by constructing resilient systems. Rather than relying on predictions or attempting to outguess the crowd, investors benefit most from strategies that withstand uncertainty and adapt to changing conditions. Robust systems provide a framework for consistent decision-making, minimizing emotional reactions and reducing vulnerability to market swings. This approach fosters confidence, allowing investors to focus on long-term goals rather than short-term speculation. Ultimately, it is the strength of these systems, not the ability to forecast trends, that delivers true ease and security in the investment journey. A fortress-like investment strategy is built on several key practical elements. The margin of safety involves purchasing assets at prices well below their intrinsic value, reducing the risk of significant losses. Focusing on quality means selecting investments with strong fundamentals, such as reliable earnings and robust management, which can better withstand market volatility. Diversification spreads investments across different sectors and asset classes, helping to minimize the impact of any single downturn. Automation streamlines the process, ensuring consistent application of the strategy and reducing the influence of emotional decision-making. Together, these components create a resilient portfolio designed to endure a variety of market conditions. By embracing these lessons, investors cultivate a mindset that is resilient to the fluctuations of market cycles and the constant stream of financial news. This approach encourages a focus on long-term strategies rather than short-term reactions, reducing the emotional turbulence often associated with investing. As a result, individuals experience greater emotional ease, feeling less compelled to react impulsively to market volatility. Confidence grows as investors rely on well-founded principles instead of speculation or fear. Ultimately, this shift frees them from the anxiety that can accompany unpredictable markets, allowing for more rational and composed decision-making. The journey becomes less stressful and more rewarding, fostering a sense of control and stability in their financial lives. If you found this analysis helpful, make sure to like and subscribe to stay updated with our latest insights. Share your own experiences and lessons learned from financial history in the comments below. Your perspective could help others navigate similar challenges. We value your input, so let us know which topics you'd like us to explore in future episodes. Whether it's market trends, economic crises, or investment strategies, your suggestions guide our content. Together, we can build a community focused on learning and growing through financial knowledge. As we reach the end of our exploration, it's important to remember that history is more than a record of past events. Its true value lies in the lessons it offers for shaping our decisions today. Rather than simply watching history unfold, we can apply its insights to strengthen our investment strategies. By learning from previous successes and setbacks, we become better equipped to navigate uncertainty and adapt to changing markets. Let history guide you, not just as an observer, but as an active participant in building a resilient financial future.